So the pattern is bullish. It's telling us that the move up is coming. If you want to be safe, wait for it to break above this trend line and hop on board. And you could be looking at, a 2-year price target, maybe of as high as, $45 to $50 on silver. So it could be really remarkable. And what you can see here is that silver has been trading in a range, and this is actually a bullish consolidation pattern. So if I zoom out, you can see here the low pivot from March 2020, and then the big move up. And then since then, it's been digesting that move. And stocks and commodities and currencies do this type of thing where they have a big move and then they need to digest it, kind of like a runner running a marathon. You can't run back-to-back marathons. You got to take a break. You got to refuel. Then you can go on your merry way. So what I'm watching for here on silver is that you have a very defined kind of wedge pattern. And here you can see the previous top over here in kind of July, August of last year. And then this was the Reddit crowd kind of pumping it up, trying to do the squeeze. It ultimately failed at the time. And then we came back in. But notice the pivot lows here. Pivot low, and pivot low. And that's the latest low we hit, and we're starting to rise. So what you're going to look for here on the silver chart is very simple to follow. When you take out this trend line here to the upside, you're going to get a break to the upside on silver, and a big breakout at that. So the pattern is bullish. It's telling us that the move up is coming. If you want to be safe, wait for it to break above this trend line and hop on board. And you could be looking at, a 2-year price target, maybe of as high as, $45 to $50 on silver. So it could be really remarkable in terms of the move that we could get here. So people want to have physical in their hands because it's something that they can hold, they can feel. You can feel the weight of that ounce of silver in your hand as well. So you're going to have always that demand. For instance, I love keeping silver and gold, the physical with me, obviously locked away in safe locations. But I also do investments where I'll buy the ETFs to play them because it's very easy to trade in and out of those versus selling your silver that's physical. So that's really the kind of the difference there. It's how fast are you looking to exit? If you're going to hold for a long-term investor type mentality, then buying the physical is awesome. If you're going to look to exit it really quickly, you don't want to go sell it to a buyer and then they're gonna knock you off the price in terms of what kind of cut that they want to take of that. So I think that's the key there. One thing to note, which is fascinating, is that the crypto bull market we have seen is really a very positive thing for the metals market. Now, a lot of people would say, oh, well, the crypto market has taken a lot of money away from the metal market. But in reality, it's made the younger generations, the 20-year-olds, the 30-year-olds, very aware of diversifying out of dollars. Now, right now, the crypto market has pulled a ton of those investment dollars into it. But eventually, as the crypto market cools and pulls back, you're going to see people saying, okay, well, I don't want to hold dollars. I know the Federal Reserve is printing tons of money and probably will continue. So where am I going to put my money now? And gold and silver will be a definite recipient of the younger generations. And it's a great thing overall. It's a cat and mouse game with the Federal Reserve where, they might be concerned about it, but if they say they're concerned about it, the markets will freak out and have a major collapse. So that's the tricky thing is as an investor, we have to kind of decide what the truth is and then position ourselves as carefully as we can to be safe in these situations. I think the fact that Janet Yellen mentioned interest rates going up last week wasn't a fluke, even though she walked it back. I look at the Federal Reserve as an entity that slowly wants to warm the water up for the market. If the market's someone getting into water, you don't want ice cold water or super hot water. They've got to do it slowly so you get accustomed to it. So, a Fed president might say, oh yeah, we may raise interest rates at some point in the future, but Jerome Powell's like, no, let's, trying to keep the calm. And then Janet Yellen says it, and then it slowly gets the market to become more accustomed to this idea. Ultimately, interest rates have to go up. I don't think you can print as much money as they have and have as much stimulus as the government has done, run up the national debt like this. Other countries are not going to continue to loan us money for tiny interest rate returns. So if you look at the gold chart, it's basically replicating the same situation that occurred in like the 2007-8-ish period, where you could see you had this 1979-1980 high on gold. And then when you came up to that same high in 2008-ish, you broke it briefly, and then you had this retrace back down before a bigger breakout to the upside. And then what's so cool here is that we've done the exact same thing from the high here, which was what, in 2009, maybe 2008. And we broke it recently over the last 6 months or so with that big move up. And then we're doing the same retrace. And it happens to be a Fibonacci 382 retrace. And we've basically come down to the target. And now we're starting to see the move up on gold start, which should replicate the move up here beautifully to the upside of this latest breakout. So again, look for that to occur. Look for a move up significantly in gold over the next year or two. I actually have a chart that pinpoints potential targets, and let me bring that up for you guys here. Here it is. So basically, if you take the low of 260 to the high here of 1920, and then you take 1200. So this move here was a $1,660 move up. You would take this low, which was the lowest pullback over the last 5-7 years, and you would add that same 1660 to it, and you'd get a target of $2,860, giving you a beautiful price target on gold of just shy of $3,000 per ounce. And I love that stuff. I love doing these types of charts because it's amazing. If you think about, here you have gold replicating to basically the T, exactly what it did the last time it broke above its high, with it pushed through, then it pulled back. Everyone said, oh gosh, it's not, it's a failed breakout. And then it just started to zoom higher. And that's what I actually think will happen to gold. And I think it's one of the easiest trades because the government's going to have to print more money. They have to do it. They have to pay the interest on the debt. There's no way around it at this point. If for some reason, the printing of money stops, or if they really put the brakes on the debt and they start reducing it by extremely, higher taxes, those type of things would kind of get my attention. I don't personally think that will happen, but it is a problem. The other thing, it's a very long-term thought, but, in the next 50 years, if Elon Musk starts mining gold on asteroids, they say there's asteroids out there that have more gold than on the entire planet. Those would be something where I would say, okay, let's get out of gold. We'll find something else and we'll invest there. But that's so far off. I don't think it's an issue at this point. Continue to like gold. I think that gold is going to be a safe haven. I'm expecting a very rocky second half of the year for the stock market. So I think money could come out of that. I also think that the risk appetite has pushed capital from gold, which is kind of boring, going up or down 1% here and there, to the crypto market. I think you'll see a pullback on crypto, and money will flood into gold as a play there as well. And I think the concerns over inflation will mount in the second half of the year as well, with these crazy moves in lumber, steel, copper. All these type of moves should be very good for the metals overall.